Hi, this is Adam Khoo, and in this video I'll be talking about the difference between stock investing and stock trading. Two very different games that can build your wealth, but a very different set of rules. So in stock investing, we are focusing on the value of the business behind the stock. Because remember, when you're buying a stock, you're buying part ownership of a business. So what drives the value of a business? Well, simply sales, net profit, and cash flow. So as investors, we want to identify very good businesses by reading the financial statements. So these good businesses have a sustainable competitive advantage that allows the company to increase its sales, profits, and net income consistently over time. So when you identify a good business, you are confident that over time, the company will increase in value. Because when a company increases in value over time, the share price will eventually become higher. The share price will eventually reflect that value. But here's the thing. In the short term, does the share price, the market price, always reflect the true value of the company? No, it doesn't. Because in the short term, the stock market can be irrational. In the short term, the stock market is highly emotional. Prices are driven by demand and supply, that's driven by the emotions of fear and greed. That in turn is driven by events like tariffs and trade war and Korean crisis. So because of that, stock prices move based on short-term emotions like that. It goes on uptrends, it goes on downtrends, goes sideways, uptrend again, downtrend, sideways, uptrend, downtrend, uptrend, and so on and so forth. So in investing, the key to winning the game is to, number one, be able to identify good businesses with a sustainable competitive advantage, like Alphabet, like Amazon, like Procter & Gamble, like Unilever, like P&G, companies that you know will increase in value. So that's the first thing. The second thing as an investor, again, is to be able to calculate at any point of time the intrinsic value of the company. So for example, at this point of time, we know that this is the intrinsic value of the company, which is represented by this black line. Once we know the intrinsic value of the company, we buy when the share price is selling below the intrinsic value. So whenever the price, the red line, is below this, it is undervalued. And when the price is above the intrinsic value, it is overvalued. So as investors, we want to buy during short-term market corrections, right? When there's some kind of crisis and the price goes below the intrinsic value, we buy when it's undervalued. Now, that's what we call value investing. But the trouble with value investing is sometimes when you buy cheap, cheap can get cheaper or low can get lower. So as investors, I believe the best way is to use value momentum investing, which means we don't just buy when it's below intrinsic value, we buy when it's below intrinsic value and there's upward momentum as well. So these are the times we accumulate the stock and we accumulate the stock when it's undervalued and it's starting to move up. Now in investing, when you identify a good business and you hold on to it over time and allow it to compound your wealth, what's the win rate? In investing, the win rate should be 95%, 90 to 95%. In fact, I can tell you that my personal win rate in investing is close to 100%. Because once I find a good business, I know for certain it will always go up over time. Of course, eventually a good business can become a lousy business. That's possible. So you have to know when to exit a lousy investment once the value starts to go down, when the company loses its competitive advantage. And in investing, you do not put a stop loss. There's no stop loss because you're buying a good business. You know that over time it will increase. So even if the price drops some more, you can average down. You buy more as it goes lower. So that's the game of investing. Now in contrast, stock trading is a very different game. When we are trading stocks in the short term, we don't care at all about valuation. We don't care that it's a good business. Who cares what the business does? We only care about the short-term price movement. So in trading, we're focused on recurring price movements driven by collective human psychology. In other words, we're looking at trends. When the price moves on an uptrend, on a downtrend, on a sideways trend. And in trading, we're getting in and out really fast. So when we see an uptrend, we quickly buy and we sell, for example. So we go long, we buy and sell, we make a profit. If it goes down, we do a short sell. We sell high, we buy back low. We don't care about the value. We buy high, we sell higher. We sell low, we buy back even lower. So as a result, in short-term trading, do you get a 95% win rate? Of course not. Because in short-term trading, you're getting in out within a couple of days or even within a day. So in trading, your win rate is only about sometimes 45 to 60% win rate. You're only right about half the time in trading. And in trading, you always place a stop loss. So half the time when you're wrong, you always lose, for example, 1% of your capital. And when you win, you always want to win 2% of your capital. You're risking 1% to make 2%, for example. That's trading. But recall, in investing, your win rate in investing is 90 to 95%, and there's no stop loss whatsoever. And that's the big difference. So it's kind of like relationships. So long-term investing or investing is kind of like getting married. When you get married, you don't need to use any kind of protection, right? When you get married, you are loyal to the person, you're loyal to the company. So even in the short term, if that person goes nuts, they go through mood swings, you hold on to that person because you know that person has got good fundamentals, person has good character. Over time, the relationship will flourish. Make sense? But in short-term trading, it's kind of like going for a one-night stand. So in a one-night stand, you don't care about the person's fundamentals or the person's values. You're just going in because the price is going up, right? Getting out when the price is going down. So in short-term trading, like a one-night stand, you've got to use protection. You've got to protect yourself, and you've got no loyalty. You're in and out really fast. So here are some examples of, again, really good businesses that rise in value over time. And one of them is obviously Procter & Gamble, P&G, that owns some of the biggest brands in consumer household items, consumer toiletries, right? So you can see that over the long run, right, Procter & Gamble increases in value. So the green line is the intrinsic value. But again, in the short term, you can see that the price does not follow the value. Sometimes the price crashes all the way down during the financial crisis. It goes up, and it goes up all the way, and it crashes down, goes up, goes down. So again, like I've mentioned earlier, whenever the price is below the intrinsic value, like over here, and over here, and over here, these are great buying opportunities for investors because you're buying when the price is undervalued. And again, a lot of people would just buy right about here, for example, when it's undervalued, right? We call them value investors. But again, the problem with that is that, low can get lower, cheap can get cheaper while it's on a downtrend. So I practice what is known as value momentum investing, which means I buy when it's undervalued and also showing price momentum going up. In other words, I wait for the trend to change. You can see that this is a downtrend over here, and that's an uptrend over here. So I will only enter somewhere there when I see a new uptrend with higher highs and higher lows while the price is undervalued, right? Same thing over here. So you can see that in the short term, the stock price moves in trends over there. So this is a downtrend, it's an uptrend, uptrend, uptrend over there, downtrend over here, uptrend over there, and downtrend over here. And as mentioned again, for short-term traders, they don't care about the valuation at all, right? Traders only focus on the price action. They only focus on the trend. So uptrend, basically they'll buy somewhere over there, buy, and they'll ride the trend and quickly sell to take a quick profit out of the market, right? And when they see it's a downtrend, they'll do a short sell, and they could buy it back quickly before it goes up again. And they're going in and out, again with a stop loss that's really tight. So they win 50 to 60% of the time. They're risking 1% to make 2%. Again, for long-term investors, there's no stop loss. You just buy and hold for the long run because, as an investor, you're buying a good business. It will always go up over time. You take advantage of buying when it's undervalued. Here's another example of Caterpillar. Again, it's a great business. It's a brand monopoly. In the long run, it always goes up. But again, there are times when it's on a very strong uptrend, times when it's on a wedge pattern over here, it's a downtrend over here, it's an uptrend over here. So again, you want to buy at this point when it's undervalued and on a new uptrend. Undervalued on a new uptrend. So lots of people ask, how does stock investing compare to stock trading in terms of performance? Which one is better? So to answer that question, let's take a look at two very different kind of money makers. So the first person is Warren Buffett, and Warren Buffett's company is Berkshire Hathaway. And he's an investor, obviously. He's a total investor. He does not look at stock charts. He just looks at the fundamentals of the company and buys when it's undervalued and holds the company for the long run. Now, contrast that with another person called Bill Dunn. Now, Bill Dunn is a trader. He's not an investor, he's a trader. So he goes long on uptrends, he goes short on downtrends. And Bill Dunn runs a fund known as Dunn World Managed Accounts. Okay, so again, they have both very different games and styles. So take a look at the last 30 years and how they've performed compared to each other. So if you take a look at this chart, you can see that the performance in blue is Berkshire Hathaway, which is Warren Buffett's company. So if you had invested $1,000 in Warren Buffett's company or his investment style, you can see that over the next 30 years, you'd have grown to $22,000. On the other hand, if he was invested with Bill Dunn and he, again, trades the money, goes in out really fast, purely through trading the price action, you have grown to $31,000. So in other words, in the long run, which is the winner, the trader or the investor? Well, actually, it's about the same. It depends on which period. For example, at this time, you can see that Bill Dunn outperformed Warren Buffett. The trader beat the investor. But during this period, which was, for example, in 95, you can see that at this period of time, the blue one, which is the investor, beat the trader. So the point is, there are times when trading outperforms investing, and there are times when investing outperforms trading. But in the long run, they both do equally as well. And the key is to stick to the rules of your game. Now, there are some people who purely focus on investing. For example, Warren Buffett is purely an investor. He doesn't trade the markets. And then there are some people like Jesse Livermore who used to be fully a trader. He doesn't invest, he just trades the markets. Now, I am one of those people where I focus on both. I've got an investment portfolio and a trading portfolio, and they are for very different reasons. My trading portfolio is where I get in and out of the market really fast. I trade both the stock market and the forex markets. So my trading portfolio, once I put money in, I never put more money in anymore. In fact, I take money out. I trade for quick cash flow, right? In fact, I teach this in my professional stock and forex trading courses. But once I generate cash flow, I then take this money and I put it into my investment portfolio where I buy really good businesses which I hold for the long run that will compound and increase in value. And that's where I teach that in my stock investment course, which is a value momentum investing course. So the point is, there's no right or wrong. There are many ways to build your wealth in the markets, but you got to understand trading and investing, different set of rules. As long as you stick to your rules, you will be profitable. What you never want to do is to mix your rules together. Like some people say, okay, I'm going into Facebook for a short-term trade. Once they get in, it drops. They say, I'm not going to cut my loss. It's now becoming an investment. Never let a trade become an investment. Never let an investment become a trade. Keep it the way it is. Focus on the rules, and you will prosper no matter what you do in the markets. So to summarize the difference again between investing and trading, you can take a look at this table. So investing is a medium to long-term holding period of 3 to 10 years, whereas trading is very short-term, could be in and out within a day, within days, or within weeks. In investing, we focus on the company fundamentals, the value of the business. In trading, we just focus on the short-term price movement and the repeatable price patterns using technical analysis. In investing, we look for 10 to 25% returns a year. In trading, it's 5 to 20% a month. Okay, but you say, hey, if trading's that great, why don't we just do trading? Well, it's because it takes a lot more skills and a lot more time, whereas investing requires less time and less skill. So there's no free lunch in this world. You want to make a lot more money, to spend a lot more time, you have to have a lot more skills. Now, investing, on the other hand, has a win rate of 90 to 95%, provided you follow the steps of how to find and identify good businesses that have got value momentum investing characteristics. And that's what I cover in the course, the value momentum investing course, which I teach online as well as live. So very high win rate for investing, but very low frequency because you buy and you hold it for many years, and so you've got a long time to get it right, basically, right? But in trading, it's a lower win rate. It's only a win rate of 50%, at the very most 60%, and there's a lot more frequency. You get in and out really fast. In investing, you don't use leverage. In other words, you buy with cash. But in trading, you need to use high leverage, which means you need to borrow in order to invest to create a leverage effect, which means a small percentage in the price movement leads to a higher gain in your portfolio. So higher return, but higher risk comes along with it. And that's the main difference. So whether you're an investor or a trader in the stock market, you can build your wealth successfully. You just have to follow the rules and be disciplined on your investment and trading plan. So this is Adam Khoo, and may the markets be with you. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.